All Canadians, not just the ultra high net worth ones, face a silent challenge when it comes time to transfer their wealth to the next generation, and that is steep tax bills applied by CRA. The Canadian tax regime does not specifically have an estate tax like the IRS tax code does in the United States, but it doesn't really matter. All Canadians will face a tax wall when it comes time to file their terminal tax return on their estate. Today, we're going to explain why a strategically placed life insurance contract can help alleviate your state of thousands, hundreds of thousands, or even millions of dollars in taxes due to your estate. So let's dive in. Canada has no formal estate tax, but CRA will apply a deemed disposition on the entirety of your estate, with some exceptions that we'll talk about, on your final tax return. This can include a disposition of all your capital property, such as money in an RSP, in your non-registered investment accounts, either in the form of income or capital gains, or they could assess other capital gains. Even though you didn't sell the property, technically, it is still deemed to have been disposed. These are assets such as shares of private corporations, vacation properties, rental properties, and even your principal residence. These provisions in the Income Tax Act, which can help reduce the pain of this deemed disposition, include but are not limited to things like the spousal rollover rules, the principal residence exemption, and things where your accountant can do things like post-mortem planning, most often referred to as loss carryback or pipeline planning, as allowed within the Act. All these estate taxes must be paid by your estate before any assets can be distributed to your heirs. Once these liabilities have been satisfied, your executor will receive a CRA clearance certificate, which then will allow them to distribute the balance of your estate to your heirs after the taxes have been paid first. According to a study done by IG Wealth in August of 2023, 88% of high net worth Canadians plan on having an estate that they intend to pass on to their heirs. But only 54% of those Canadians carry life insurance, and only 17% understand the tax planning benefits that life insurance can provide. Over 58% of high net worth Canadians do not have life insurance as part of their estate planning strategy. So what is a life insurance policy, and how can that help alleviate some of these tax liabilities? A permanent life insurance policy, which could either be a whole life or universal life policy, offers a tax-free death benefit that can be passed directly to your beneficiaries. These policies can also be structured to hold tax-exempt cash value, which can be passed to your beneficiaries or accessed by you during your lifetime through contractually guaranteed privileges. So remember, at your time of death, CRA counts all your assets as being deemed to have been disposed of. The estate tax liability due effective the date of your death. If your estate does not have available liquid cash to be able to pay for this estate tax liability, both on the liability of the estate and the liability in your final tax return, your executor may be forced to liquidate some of the assets without that available cash. Of course, the issue becomes twofold. Is there additional tax to pay once those assets are sold for cash? And what if those assets are depressed through, we're seeing right now in the real estate market, there's some volatility in the values of some real estate. Would you want your executor to sell at a loss just to be able to pay these estate taxes? So here's how life insurance death benefits work. Life insurance offers instant liquidity, providing capital at the time that capital is really required. This can help prevent the forced sale of other assets, which preserves your estate for both the risk of volatility and additional tax. Sometimes we see families who own a Canadian corporation who maybe one of their children are working in the company and another is not. So what to do with these shares, which may form a significant part of an individual's estate? So life insurance can equalize an estate, providing cash to the child who is not participating in the business, while the child who is can just simply receive all the shares of that business and move forward. Basically, you can gift the shares of your corporation that you've worked hard to accumulate a value to, and you can gift that to the child who's participating in the business while compensating others equally who are not participating in the business. Life insurance can also be used as a funding mechanism to facilitate the funding for partnership agreements, providing a way to avoid hiccups if a co-owner of a corporation passes away. Additionally, life insurance policies can shield your assets from creditors if structured correctly, which is a key benefit for many Canadians. The unfortunate reality is that many Canadians are unprepared and have not thought their estate planning all the way through. Imagine how your estate would go through an undocumented or unstructured estate plan, negligently paying thousands, tens of thousands, hundreds of thousands, or even millions of dollars in taxes where it could have otherwise been avoided. Life insurance is a key component to any estate plan, providing payouts with no probate delays, no forced sale of assets, and no cash-strapped heirs. Just a clean, efficient transfer of your wealth. So if you're a Canadian or an advisor that works with Canadians, don't overlook the power of life insurance in the Canadian income tax and estate planning system. Life insurance just isn't protection. It's a tax-free liquidity tool that can preserve your estate for the people you intended to transfer it to. If you like this content today, help this channel out. Hit like, share a comment about how you're planning on using life insurance as an estate planning tool, and subscribe to see upcoming topics on politics, history, economics, financial literacy, and philosophy. And I hope you enjoyed today's topic.